Hey guys, thank you for stopping by. Don't forget to subscribe, like, and share. And I hope you enjoyed this interview. Transportation. Oh, I and Prof have started speaking already, and director cuts me there. But it's okay. Let's continue. Professor Ken Ife, development economist, is here with me, and we are looking at the implications of this match, MPC decisions. Of course, Dr. Tumala gave us earlier on what the MPC considered and where we need to go from here. Prof, just before th that, we were talking about the FX component in terms of the transmission mechanism. In fact, when Doctor was speaking, I was like, oh, I just had a ha-ha moment in terms of that. So I don't know if you would like to begin from there.
Okay. You know, first of all, before I launch into that, you know, the CBN is concerned about price stability, which is their major mandate. But remember that there are so many price issues around monetary policy. You have MPR rates, it's price. You have inflation, it's price. You have Forex, it's price. And then even interest rates charged by the banks, they are all linked to MPR. So what happens is that there are going to be price discovery, as the governor says, in all of these areas, because in all of them, there is demand and supply perspectives in all of them. So when you now start coming down, then you are going to see that you are going to ask the question, okay, for inflation, our target is to bring it down. Okay. MPR rates, what is our target? Then we will come to why it has to go up, because you should have asked me, why is it not going down? And then if the Forex is going down, has to go down, inflation has to go down, then why is MPR rate not going down? So that's where you now find out that MPR rate is also chasing a macroeconomic parameter, which according to ECOWAS macroeconomic convergence criteria says there should be a positive real interest rate. So with inflation being at a distance from monetary policy rates, we're in negative territory. So they have to be upping it and bringing down inflation until we come to that comfort level where you can now, the signal is going to the capital market. We are trying to do something here to encourage inflow of dollars into the system. Because remember, that will help the supply of dollar against the demand for dollar. So these three are going to be pulling in different directions, but they're all heading to some equilibrium. Some equilibrium, which the governor says price discovery. It's just another way of saying we're going to find where the equilibria will lie in all of these price mechanisms. And it's not very easy because you have speculation in the mix. And so that's why, apart from the influx of money into the dollar, into the system from the foreign direct and the inflow, and also the diaspora remittance, but there was also a shakedown on the speculators in the market there. So you have Binance that we couldn't see where their $26 billion have been flowing, and then somebody's on the run. And then you also have banks being told, oh, remove anything outside your net open position of 20%. And then, so you've seen all shakedown going on that is actually, creating nervousness in the speculative community. And then also see the winning the BDCs and giving them some. So it's all a orchestrated shakedown to enable this to come. And it's coming. But it has to be sustained over time. Now, come to your question. Now, you were asking about the impact of the Forex on inflation. Now, I want to tell you 4 things about the inflation. There are 4 different, first of all, we are in stagflation. Many people need to understand what it means that you are in stagflation. We are not in an ordinary economic event. We are in stagflation. And that worries many countries in the world. So we have a little of 4 major inflation, all active in Nigeria right now. We have cost-push inflation, which you have seen is accentuated by the high rise of diesel price, petrol price, transport cost, the knock-on effect on transportation costs. And then that will explain to you why you have wide variability on inflation across the states, to the point that there are about 20% variability. In people like Kogi and Kwara, you're having as much as 40% and reverse. And then for some, that 20. That variability, transport is dominant there. But with the diesel coming down to 1,000, because most of that transport thing is about diesel, either buses or trucks. So that will definitely come down. So you are going to see how, to some extent, there will be some moderation on the cost push inflation. Okay, now let's look at the imported inflation, which is where your question comes in. The imported inflation has two components. Now, you have the food, processed food. Now, imported processed food carries its own inflation into the system and is a pass-through. Now, what then happens is that if you look at foodstuff basket index, it has imported processed food component of is processed food plus farm gate prices. Those two. And then the same imported, so the same food, processed food is in the core inflation. So both of them, both at the level of food inflation in sub-index and at the level of the core inflation will be reduced by a lower exchange rate. So it doesn't mean you won't import, but the price will not rise as much. Because, and it will affect both. Now, how do you get a sense of the distance? If you look at the distance between the headline inflation and then the core inflation, that gives you an idea of the headline inflation is 31.7, and then the core inflation is 25. So you see about 5 to 6%. So you could see that that is the kind of area where it will bring down. And as it's bringing it down, it's also bringing down the food basket. So give and take, let's say about 3% or so will be affected. So that is how it comes to that. But then there are also other things that are imported. It's not just processed food. You also have capital goods that are imported, which are also going to affect cost of production and all of that. So all of those are going to be affected. But when you look at the other inflation thing, you know, I talked about supply, cost push inflation.
Cost push.
I talked about imported inflation. But there is demand pool inflation. No, sorry. The main inflation, which is money supply, is being addressed head on. And that's one of the reasons why we are bumping up the MPI rate, of course, and then we are sucking out oxygen from money supply. All of that is to, to deny us this. So that is active. But the fourth one is the one that is less given attention, because what you call demand pool inflation, which is the one from neighboring, that is demand pool in the country, which is what the money supply, sucking out money supply is helping you to, but there's a demand pool from the neighboring states, countries. Now that is the one that is very problematic, because it is predicated on the difference between our currencies, which you know has moved from 1 naira to 3 sefa to 1 naira to 0.8 sefa. So to them, it looks like, oh, getting anything from Nigeria is very cheap, up to 8% cheaper. To the fact that, even though their situation is aggravated by weather condition, they have a higher elasticity of demand. Because if you double the price of grains at the frontiers, they will still buy them. They're still cheap for them, 40% cheaper. But to bring it down to Nigeria, further down south is a problem, because transport costs raises the price, and we can no longer afford our own food. So what you do here are two things. We have to get down to, and then the other problem there is that ECOWAS Treaty protects everybody, protects them. They have to move those. They're not even paying dollar for it. But when you add value, if we have world level processing, you have added value, they go to ETLS. They have to pay duty, unless they can prove rule of origin. So that is one. But the other strategy is you have traders all over the place mopping up the goods being produced, even though we're not producing enough. So if you have a marketing board that is active, that can actually buy from the producers, aggregate, and then find local processors to give it to them to process, then you can actually fight the exit of the raw goods. So that is the area, but it's fiscal. You're not going to say, Central Bank is not going to get it. It's running away from intervention. So what are you going to do? It's fiscal. Fiscal has to deal with that.
So now let's talk about, let's take a look at other central banks too, and in terms of the push even to positive real interest rates. Can we have those cards again? For example, South Africa is doing, their MPC meeting is today. I think it will be 3 p.m. South African time, which will be our own 2 p.m. So the doctor, Prof, Prof, that's it there. You need your glasses to see.
No, it's all right.
Yes, what we have there. So, of course, Nigeria's January inflation was at 29.9%. Our MPR then was 22.75%. So we still have a negative real interest rate of minus 7.15%. How you arrive at negative real interest rate? Just take away 22 from 29. So you people shouldn't just say, what are we doing here? It's just simple arithmetic.
Yeah, that's
then
right.
February inflation, I can see that 31.7%. That's March MPR, of course, which was just announced yesterday, 24.75%. We still have a negative real interest rate.
Yes.
But now it's reduced from 7.15 to 6. What's that? Is that 6.95?
Well,
okay,
6.95. Yes.
Okay. Then now let's go to Ghana. Ghana's February inflation 22 point, is it 22 or
23.2?
23. Even
and
with
then
my glasses,
MPR 29.
Yes, MPR 29. That decision was just done a few days
positive
ago.
5.8.
Yes, so you have a really positive interest rate there of 5.8%. South Africa, I mentioned earlier. South Africa, the last MPR was at 8.25%, inflation of 5.6%. But let's even go back to Ghana a bit, Prof. This is a country that also battled with inflation last year, August, September, at over 52%.
I know.
I wonder how Ghana dropped to this 21%. How did, and of course, I know that IMF also on Ghana.
Yeah, they've been pumping money.
They've been pumping money.
$3 billion.
Egypt to $3 billion.
Also receiving, yes.
So how do you now, yes, thank you guys for doing that. Now we're seeing Kenya. So Prof,
Kenya
analyze,
is positive as well.
Yes, Kenya is positive. So, Prof, analyze all of these
the
countries.
Thing is that the capital, the injection...
Nigeria seems to be still wider.
Yeah, we are wider for so many reasons. I mean, insecurity is hitting us in a way that it doesn't touch all these other countries. And then we also have a lot of distortions in the... I mean, this is what the CBN governor keeps saying, that there's distortion. So the distortions is about... So the objective is to move to a perfect market, which we don't get, but at least move towards a freer market. And the freer market is described as when you have willing buyer and willing seller.
But
there are other distortions around it that are making it difficult. That's why you have speculators going on, you have all that. So they're dealing with some of those distortions.
Would you say you're still doing a free market when the BDCs are getting $10,000 now?
No, but it takes time.
It's not willing seller, willing buyer again. I know it's difficult. Those of you that are economists, it will work well in order. When it comes here now, we'll find a way to be padding it.
Yeah, we have our own political economy is very unique. In the Francophone countries, you have a commander there in chief, which is France. And they've got all their money, CFA, linked to euro. They control 80% of their reserves. They bond that reserve to keep that value. And that's why our depreciation is very exacerbated at the frontiers. So you've got that policeman there running their monetary policy. I mean, we are running our own here. So we have a different kind of context. And then, of course, the ones you mentioned, Ghana and all that, they had some goodies from the IMF and all of that. And don't forget, when IMF bring their dollar, they enter into the calculus, forex calculus, and then reduce. And they're a smaller economy. So when you take $3 billion into Ghana, it's like bringing $30 billion into Nigeria. All right? So we are about almost 10 times their size. So they could have remarkable impact on their forex calculus than it will in Nigeria.
Let's talk about the depreciation of the naira. Of course, in the last 1 year, we've seen about 70% depreciation of the naira. How does all of this pass through? Because what I've also realized is among all these rates and all of that, we still get to see relationships. Now, what would you say about the fight against Naira's volatility from the Central Bank of Nigeria, especially with what Governor Cardoso mentioned yesterday? Do you see the Naira still strengthening?
No, the Naira is going to continue to strengthen.
To like how much?
No, well, I think it might probably be looking maybe in the next 4 or 5 months to coming close to 1,000 Naira to $1. That is, I will see that going up. But the thing is that the effect it will have on inflation is what we should be watching more, because if the inflation comes down, then the MPR rate does not need to go up more. The MPR rate will be going on. The next one, it will still go up.
so that we can have a real
so
positive.
He's chasing a positive, real positive interest rate. And then, of course, that also means that treasury bills and some of those things will also be attractive to the portfolio investors. And don't forget that portfolio investments will cancel out too, but they bring instant liquidity. So that is the difference.
Prof, but that also means that our own manufacturers and production here also get strangled in terms of cost of credit at the banks are also very expensive.
Yeah, yesterday that's the one that worries me the most.
Yesterday, CRR for banks, 45%. Of course, it was still a constant. MPC retained that. But the interesting part of it, which I also want you to comment on, is the merchant banks part of it in terms of
from
CRR,
10 to
14%. Yeah, so looking at the cost of credit, because even if we're chasing a real interest rate return to be able to attract as many FX as possible, our own local economy too, our own local producers also need to breathe to be able to produce that would also filter into our own local inflation. So many.
That's what you're saying is true. But consider the fact that we are not sacrificing this purely to get
FPIs and
foreign portfolio investment. No, because we're also pursuing this to bring down inflation so that people can buy something with their money. Because the standard of living and 140-something million, 33 million people in poverty, we are bringing that down to make sure they can have they can breathe fresh air. And then also hoping as well that as we are coming down, that the rate is going to be sufficiently attractive for these inflows. And of course, with diaspora remittance increasing significantly, and then government revenue, which is where the fiscal comes in, government revenue is increasing substantially. Then government is also addressing cost of governance by merging all these ministries, and then they are blocking all the loopholes, and you can see government revenue going up to 2 trillion a month, heading to 24 trillion a year. So there are substantial changes going on. So and it will now bode well for not only because when you do salary increase in May, I'm not sure how much is going to come out with the minimum wage, but that minimum wage will be able to buy something because inflation is coming down.
So the target really is to bring down inflation.
That is the main target.
How many times will you increase wage?
200 million people can actually buy something with the money that they have. And so that's a different scenario to how you're going to support the industries. Because the industries, I'm telling you this, we are an import-dependent economy. You know what you call the common denominator, which is not being talked about that much, is that this economy is import-dependent. And if you continue on this track, it's all going to be struggle. Me and you will be back again to talk about this because there will be struggle and juggling and juggling and juggling. If this economy is exporting and then buying less from even this what we import, if we can get it from Africa, then we haven't got an issue because we use our naira to pay under the FAPs.
Yeah.
We use our naira to pay. And that is the transition that has to take place so that the people that are around us are doing the business and we're paying with them. So that will make a significant change.
Okay, Prof, just 1 minute before we end this program. I wanted you to comment on the merchant bank stuff, 14%. Then I also want to get your comment on the recapitalization of the banks that MPC told CBN yesterday to.
No, it has to happen. Because look at capital adequacy ratio. If look at companies, 15%. But look at it, how the Naira has dropped, the pounds, the Naira. So imagine what it means. Some of them will have to double for them to be able to meet capital adequacy requirement. Or they have to close down some of their foreign banks. Then let alone in an economy where the currency rate has got, they have to recapitalize. So that will, and bank recapitalization is equal to strengthening the economy.
Do you see a capitalization like we saw the last time, where some banks will close, or there'll be more measures, or the banks will survive?
No, the banks are posting so much profit. You only need to take a percentage of that profit and capitalize it.
But depreciation is impacting that profit now, because when you convert the naira to dollar, it's not
but
much
that is
again.
in foreign currency terms for those that are trading abroad. That is where the capital adequacy is critical, which is our 15%. But for our own here, so our capitalization needs to take place because, as I said, just look at how much they're able to lend And now, if a bank takes 5-year profit, 50% of each 5-year profit, and capitalizes it, you're talking about something different, because it means that the whole bank would have been double in their capital, and then the base would double, and then the economy will be stronger, and they will finance projects left, right, and center. So,
okay, I think, Prof, let's leave it at that. Just like you said, we'll come back again to discuss this, because the denominator is the reduction of imports dependency in the country. All right, I've been speaking with Professor Ken Ife, a development economist, and we've been looking at March MPC decisions and, of course, the implications. Please join me again tomorrow, same time on this station. I am Nancy Naji. Be the best you can be and be the change that you want to see. Bye now. Thank you for watching. In case this is your first time watching us, thank you. Don't forget to subscribe to our YouTube channel, drop your comments as well as like, and most of all, share our content. Bye.